My name is Pete Williams, the host of Beer Stearns Financial Insights. So welcome to the office here in sunny Southern California. The subject is how the wealthy make their living, and it's entitled Buy, Borrow, and Die. And it just so happens that I read a headline today that the Rams billionaire owner just became the biggest private landowner in the United States. And that brings us to our subject today. We're going to talk today about how the wealthy make a living. And I know what you're going to say. Isn't it obvious? Well, not exactly. And we're going to talk about this concept of buy, borrow, die real quick. And you see, the ultra wealthy do not punch a clock or set an alarm to make sure they beat the traffic to go to their cubicle or their office downtown. They don't screw bolts in a factory. They don't pick vegetables in a field. So what do they do? And so let's get down to the BS, the Beer Stearns of it all. For the most part, the ultra wealthy, they don't live off their labor. They live off their capital. They get rental income and a capital appreciation from assets. Buy, borrow, die, which is a wealth preservation and tax minimization strategy for the ultra wealthy under the code. It's completely legal. It's been around for decades. It's even available to you and I if we have the wherewithal to take it on. But first up is the buy. And what a lot of people do, and certainly the ultra wealthy, is they buy capital assets. So that money may be the money that they made doing creating a company, a tech engineering company. Maybe they created their own wealth. Or a lot of times maybe they inherited the wealth. But in any event, they buy a capital asset. And that capital asset is something like stocks, private businesses. It could be arts and collectibles. But for the most part, what I'm going to talk about today is real estate, buying real estate. So let's say an ultra wealthy person pays, say, $10 million for a nice office building 30 years ago. And over those 30 years, it's been paying them rent, and there's other tax advantages to owning that piece of property because it's a business property. The asset goes up in value, and let's just say today that $10 million property bought 30 years ago is now worth $80 million. So the owner has a nice $70 million gain. That's nice, and not only that, but being a capital asset, if it is sold, it's sold at favorable capital gains tax rates, which go up to 20%. The ultra wealthy get to tack on a little bit, call it another 3%. So the ultra wealthy person could take that building that they purchased for $10 million and sell it for $80 million and have a nice $70 million capital gain, which is taxed at 23%. Not a bad deal, especially when you consider that it's not taxed like ordinary income rates. Ordinary income rates go up to 37%. And to boot, they add in the Medicare and Social Security taxes that we all who work off of our labor. Oh, and by the way, I almost forgot that $10 million cost of that building is recovered over time. Business property, capital property, can be recovered or depreciated, even though it may not depreciate in value. The tax code pretends like it does. That $10 million cost basis can be written off to minimize the tax effects of the rental income of that property. So really, after a 30-year period, probably a $10 million building that's now worth $80 million probably has a zero tax basis because you've recovered that $10 million cost. Has come back to you in the form of depreciation expense. And so the true gain is probably around $80 million. But again, it's taxed at favorable tax gains. So one would think that would be enough. You might think that they would thank their lucky stars for that. But no, that's not the case. Now we get to the borrow phase. Rather than sell an appreciated asset and pay capital gains taxes, what an ultra wealthy person typically does is they borrow against that asset. So they go into the bank and they talk to the Mr. or Ms. Banker and they say, hey, I need cash. I want to make other investments. I want to, enjoy my life. I want some cash flow. I want to fly up on the Blue Origin around the earth. I want to take a trip. I want to buy a yacht. I want to do all these wonderful things, but I have no cash. I'm real estate rich. And they go into the bank and they ask the banker if they can borrow money using the asset as collateral. And the banker says, yes, of course. We have some really great rates. We've known you for a long time. We know that this kind of asset appreciates over a long period of time. So it's a good risk for the bank. And the banker puts money into the ultra wealthy person's account. And of course, loan proceeds are non-taxable. So instead of selling a property and taking capital gains and having those taxed, they actually just borrow money out of the property and they get cash that way. So life is good. They've got an asset that has grown in value over periods of time. Even if they sell it, it's at favorable rates. They are able to access cash by taking loans on the property. Now, clearly, the borrowing does create monthly interest and principal payments back. But of course, they have income from the property itself, we hope. And if they're ultra wealthy, they probably are smart enough to get cash flow out of the building by rents and leases. So that's a great deal. You buy an asset, it goes up in value, and you can borrow money out tax-free. So one would think that all is great, right? Well, no, it's not. And here we come to the die portion of the buy, borrow, die. They have this gain that's inherent in the property. In our example, we'll call it an $80 million gain on the property. So when they wait till they die, and believe it or not, that gain is forgiven. It's called a step up in basis. It's in the code. It's legal. When you die, heirs take the property and they get to take the basis at the market value at date of death. So essentially, it wipes out the capital gain. No more capital gains tax. The heir could sell the property with no gain, assuming that date of death value is the sales price, and not pay any tax for all this appreciation. So that's what they do. Ultra wealthy people hang on to property until they die. And they are able to do that because they have this cash flow from loans for their lifestyle, non-taxable cash flow. Some of the arguments of why this should be, there's a couple. One is that the money's already been taxed. So the $10 million purchase price was paid with after-tax money. Well, number one, that may not be true. It may be paid for with inherited money, which is often, it's not income taxable anyway. It may be estate taxable. Number two is you get to recover that cost. That $10 million you get to deduct over time against your income. So the argument that it's being taxed twice is nonsense. With cost recovery, with depreciation, you get to recover that cost. So no, it's not paid for with after-tax money at all. Another argument has been that there is an estate tax on the estate of the decedent. And that's true. Wealthy people have an estate tax that is imposed upon the entire value of their estate. That still does not explain to me why there's a step up in basis at death. If there's an estate tax, it would make perfect sense to tax the capital gain and give a credit. There could be a credit system where you could have a credit for capital gains tax towards your estate tax. And another argument is that this gain is not our fault. We bought a property at $10 million. It rose to $80 million. It's inflation. It's government printing money that caused the rise in the value. It's not really our fault. Why should we be penalized for owning an asset that we held and inflation just caused that asset to go up in value? I'm not buying that either, because the same thing happens to those of us who work for a W-2 or 1099. those people who go to a factory, those people who go to an office building, those people that work in the fields, their income goes up due to inflation. They are paid more because of inflation. A dozen eggs costs more, a quart of milk costs more. Therefore, to keep that employee, they have to be paid more. So why is there not a corresponding forgiveness of taxation for the worker, for the person who works off of labor, like there is for the ultra wealthy who work off of capital? It just doesn't make sense to me. Another argument is that it's good for the formation of capital. Now, this one I might buy. The idea is that you want people to take risk and invest in office buildings and other capital assets so that the economy is good. And, the trickle down sort of theory that if the ultra wealthy buy buildings and create businesses, then they'll employ people like you and I. And hey, I can see that there's a need for advantage to risk takers in capital formation. I get that. I understand. But that doesn't mean we have to go too far with this. So anyway, buy, borrow, die is the concept of buying a capital asset, using it for business purposes. You get favorable capital gains tax rates if it's sold. The right capital assets generally go up in value because of inflation. And inflation, of course, bottom line is created by governments that spend more than they take in. And so if you just simply buy an asset, sit on it, second step is to borrow against it. You get loan against the property. It's tax-free. And then once you die, after living that nice, comfortable, pretty much tax-advantaged life, everything is forgiven. All capital gains are forgiven on that property. Buy, borrow, die is not exclusively to the ultra-wealthy. They do have some advantages. They have capital. They have friendly bankers, friendly interest rates. It is available to you and I. We can buy property. But keep in mind, in this country, less than half of the U.S. population has $10,000. So it's certainly not something for the average Joe. So any event, it's closing time. That's the topic for today. And we'll see you for some more BS Insights. Take care, y'all.